Cast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and thank you so much for joining us. My name is Melissa Mata. I am the Municipal Research Analyst here at the Colorado Municipal League, and I'd like to thank you for attending today's webinar, How to Avoid an ACA Reporting Penalty and What to Do if you get one. Those of you who are elected officials who have registered will receive 1 university training credit. And as an FYI, this is a popular question, today's presentation will be posted on our website, which is www.cml.org, and you'll find it under training materials. The webinar is also being recorded, so in addition to being able to download the slides, you'll actually be able to watch the recording at a later time or share it with your colleagues. For those of you who aren't familiar with the webinar format, you'll see a control panel to the top right of the screen, and you'll have an orange arrow to the left of the panel, which minimizes the entire box. All participants are muted for the webinar, but you're encouraged to ask questions by typing them into the question box that you'll see on your control panel. We'll hold a Q&A session near the end of the webinar, but please feel free to type the questions as you think of them throughout the presentation in that question box, and we'll get to them near the end of the presentation. So we have a couple of guests joining us today from American Fidelity. Gabor Siklosi is the Western Region Government Markets Manager for the Associated Worksite Division of American Fidelity. This is Gabor's 14th year with the company, and he's primarily responsible for introducing American Fidelity to new groups interested in the value proposition of the company, to educate and communicate benefit options for employees so they can make informed decisions about their financial future, and to help HR departments run their open enrollment so that they can focus on what they do best, which is taking care of their employees. We also have Mary Nash here today. She's an Assistant Vice President and Chief Operations Officer of American Fidelity, where she is responsible for the daily operations of the company. Mary has been with American Fidelity for more than 30 years, and her previous positions include Senior Underwriter and Section 125 and Flex Administration Manager. Mary has earned the Certified Flexible Compensation Instruction, Fellow Life Management Institute, Health Insurance Associate, and Associate Customer Service designations. Mary is a proud graduate of the University of Oklahoma, where she earned her degree in finance. So with that, I'll go ahead and kick it over to Gabor so that he can say hello and move forward with the presentation.
Thank you, Melissa. I just wanted to greet everyone and say hi. Let you know that I've enjoyed living in Colorado for the past 2 years in Littleton. And I am actually now in Washington at the current time. My region is the West, and so I'm missing the snowstorm you guys are about to get. So I wanted to just greet you. I've met several of you, and look forward to possibly having a conversation later. I'll turn it over to Mary now. Thank you so much, Melissa. I appreciate it.
Thank you, Gabor. I just wanted to say thank you to the Colorado Municipal League for giving me the opportunity to talk with you today. So over the past 4 ACA reporting seasons, American Fidelity has learned some really valuable lessons about where employers may falter in trying to comply with the employer mandate reporting requirements. This webinar provides a great opportunity for me to share what we've learned with you, and to hopefully provide you with some tools that you can use in case you become a recipient of one of those employer shared responsibility payment letters. Before we get started, I would like to get all of our little legal disclaimers out of the way. We've got to make our attorneys happy here at American Fidelity. This presentation is only a brief summary that reflects our current understanding of select provisions of the law, often in the absence of regulations. Any of the information presented is subject to change as the appropriate agencies publish additional guidance. American Fidelity Administrative Services does not provide tax or legal advice. While we're happy to provide you with this general information, given the complexity of these rules, we encourage you to contact your tax or legal counsel about how the requirements apply to your specific situation. So during our presentation today, we're going to go over the following topics. First of all, we're going to talk about the IRS enforcement of the employer mandate. Then we'll go over the steps to challenge a proposed assessment. Then we'll take a look at some common reporting mistakes. Then we'll go over some areas that an employer may want to review whenever they're making a response to an employer shared responsibility payment letter. And then we'll wrap it up with some tips to follow to prevent future problems. So let's go ahead and get started. Oops. Hang on a second. My buttons aren't working on my advancement. Let me get my screen to advance here. I'm sorry. There we go. Took a minute. Okay. So what is the latest news regarding the IRS enforcement of the employer mandate? I think that we're all aware that the Internal Revenue Service has started assessing employer shared responsibility payments, or what we call ESRPs, for the 2015 and 2016 tax years. The ESRP is assessed to applicable employers who either did not offer coverage to the required number of full-time employees, or they offered coverage that did not meet the affordability and adequacy standards defined under the ACA. Penalties may apply in two circumstances. The first, which is the 4980HA penalty, or what we call the A penalty, occurs when a large employer fails to offer coverage to at least 95% of their full-time employees and their dependent children, or for 2015 it was 70%, and at least one full-time employee receives a premium tax credit to help with the cost of coverage. The annual penalty for failing to meet this target is $2,000 annually, but it's indexed annually as well. And that's per full-time employee, less the first 30, or for 2015, it was the first 80 employees. And we have a slide coming up that will show what those indexed amounts are. The second circumstance that can trigger a penalty, in this case the 4980HB penalty, is when the large employer offers coverage to at least 95% of their full-time employees and their dependent children, or as I mentioned, that would be 70% for 2015. But at least one full-time employer receives a premium tax credit to help with the cost of coverage. This can occur when coverage was not offered. For example, if the employee that got the premium tax credit was one of the employees in that 5% margin of error for 2016 and after, or when the coverage that was offered by the employer was either inadequate or unaffordable. The penalty for failing to meet this target is $3,000 per full-time employee who receives a premium tax credit, and there are no safe harbors that apply to this penalty. This slide is a summary of the Part A and Part B penalties for the 2015 through 29 tax years, indexed accordingly. So you can see that each one of those penalties obviously gets larger as the years go up. You might pay special attention to the fact that for the Part A penalty, the penalty applies to all full-time employees. And that's what can be really shocking to employers whenever they get one of these ESRP letters, is they open it up and it's for a Part A penalty, and it can be quite large depending on how many employees the employer may have. We've seen penalty letters that reflect penalties in the high hundreds of thousands up to the low to mid millions. So it can be quite shocking when you open up that letter and see what that proposed penalty assessment can look like. Now, the Part B penalty is a little bit different. It only applies to those employees that have actually gone to the exchange and gotten a premium tax credit. So typically the Part B penalties are much, much lower than the Part A penalties. In the event that the IRS finds that an employer may owe a proposed assessment, the ESRP letter, which is really more like a little packet, will be sent. Included in this letter, there are about 3 forms that the employer will want to pay special attention to. That would include, obviously, the letter itself. There's some really important information in that letter, a summary table, and then what is referred to as the 14765 form, or what we call the premium tax credit listing. And then the last thing is the 14764 form, or the employer response letter. We'll talk about each one of these forms in more detail later on in the presentation, but I just wanted to touch on each one of these briefly so that you'll be familiar with what I'm talking about. On the screen right now is an example of the ESRP letter itself. You will notice that in the upper right-hand corner, there's some information that's really pertinent to the letter. It includes the date of the letter, the tax year, and remember that the penalty assessments are being sent out for both the 2015 and the 2016 tax years currently. In probably about 6 more months, they will start sending out the letters for the 2017 tax year. So it's a possibility that you could still be getting 2015 penalty assessments this year. The next thing is the employer ID number. This is your tax ID number. After that is the person to contact. And depending on which IRS office sends out the letter, the contact name could actually be a real person's name, but most likely it will just reflect that it's the 4980H response unit. It will also include the contact telephone number, that's the IRS telephone number, and their fax number. And then, of course, the most important thing that you'll probably see on this part of the letter is the response date. So remember that the employer needs to submit their responses or their response to the penalty assessment by this deadline. If you see that you are quickly approaching this, or you may not have enough time to gather all the information, we encourage you to contact the IRS immediately. Just pick up the phone and give them a call, and they will most likely grant you an extension of somewhere around 30 to 60 days, depending on the situation. I have yet to hear the IRS not granting an exception, or excuse me, an extension. So it's something that's pretty easily gotten if you need additional time. Okay, the next part that I wanted to talk about, that I wanted to mention, is the ESRP summary table. This table contains some really important information that can help the employer identify why the ESRP was triggered. Just kind of looking at the table, you'll see that in the first column, it lists all the months of the year, and then the additional columns on the form kind of go over some different things that the IRS takes into consideration whenever they're making these assessments. And again, we'll talk about this in more detail shortly. This is an image of the IRS Form 14765, or the Premium Tax Credit Listing. The employees listed on this form are the employees that received a premium tax credit during 1 or more months of the tax year. Any month that is not highlighted in gray is a month that the employee received a premium tax credit, but no safe harbor or other relief from the penalty was available for them. So it's kind of hard to tell looking at this particular form because it looks a little blue or a little gray in the shading, but when these are completed by the IRS, that information will be included, and the IRS will actually use a dark gray shading to cover up the months that really don't apply to the penalty assessment. So here's an example of what the premium tax credit listing may look like when it is completed. As you can see, there is a top line that has the name of the employee, and then it will list all the code combinations for each one of the months. And then directly below that line is another duplicate line that the boxes under the months are left blank. And that is the place where you as the employer would make any kind of code combination corrections that are necessary. Now, the letter itself is several pages long, and it contains a lot of helpful information about what steps the employer needs to take to respond to the ESRP and how to make the necessary corrections. So the employer should be sure to read the entire letter before attempting to draft a response back to the IRS. Now we move on to the steps the employer will follow to do a response to the proposed penalty. There are basically 6 steps in the response process. First, the employer will receive the letter 226J, and I interchangeably used letter 226J with the employer shared responsibility payment letter. We kind of refer to those as ESRP letters, so if you hear me say that, I'm referring to the 226J letter. The 226J letter is the initial letter notifying an employer that an assessment has been made. That was what that first page of the letter that we were talking about, the employer name, had the date of the letter and the response deadline and all of that on it. So that was part of the 226J letter. Very important to understand that this letter is not a bill or a demand for payment for this penalty. It is just a preliminary calculation of the ESRP based on the information that the IRS currently has. Employers can contest a proposed penalty by submitting a Form 14764 and any supporting documentation by the deadline stated on the first page of that letter. The 14764 is the employer response letter. We don't have a picture of it in this presentation, but there's a couple of things that you'll want to pay attention to. The letter itself will have some information at the top that has to do with the employer. It's the employer's name and address. There will be a couple of statements that the employer can check that basically says, the first one will say, I agree with this penalty assessment and will be making a payment of this penalty. And then there's some boxes underneath it that the employer can check that will tell how they intend on making that payment. Obviously, do not check that box if you intend on responding back to the IRS and disagreeing with this penalty assessment. We've had people that mistakenly thought they were supposed to mark that and send it back, but in actuality, they were actually wanting to appeal the penalty assessment itself. There is another statement that says that the employer does not agree with the penalty assessment either in part or in whole, and that they are sending some information that basically supports the reason for their appeal. Then the representative for the employer will sign it, and they will submit that back to the IRS. Once the IRS receives your response, they will respond back to you with another letter, and this is the letter 227, which describes the additional steps the employer may need to take for the appeals process. There are actually about 5 different variations to the letter 227. There's a 227J, a 227K, L, M, and N. The best outcome for the employer is the 227K, which states that the IRS has received their information and has determined to reduce the penalty down to 0. But it's also possible that the IRS will send a 227J letter, which states they've received the information and the penalty stands. They could also send any of the other variations of that letter out, which would require the employer to take additional steps to continue the appeal process. If the employer disagrees with the penalty proposed by the IRS after following the response process, it can request a pre-assessment conference with the IRS Office of Appeals. After the employer's response is complete and any pre-assessment conference has been concluded, the IRS will determine liability. If the IRS decides the employer owes the penalty, it will issue the notice CP-220J indicating the assessed ESRP. The notice CP-220J outlines the additional procedures that the employer can follow to submit questions about the ESRP calculation. They can use it to request abatement or challenge the assessment in court. It's also helpful to know that the CP220J is actually the bill for the assessment. So an employer is not actually billed for the assessment, the assessed penalty, until they receive that letter CP220J. But hopefully the proposed penalty assessment will have been cleared up long before you reach this part of the process, and the employer won't have to go any further to get the penalty taken care of. So now let's look at some common reporting mistakes that can result in the ESRP letter. So what causes mistakes that can have the IRS generate these letters to an employer? In many cases, employers who receive the 226J may actually not owe an ESRP penalty at all. The ACA, particularly the employer and employee, or excuse me, the employer and individual mandates, was a new law, and it has some very complex rules. This, combined with some technology or software challenges that the employer may have been faced with, may have resulted in just some incorrect information being sent to the IRS on the Form 1094 and Forms 1095C. Based on the information on those forms, the IRS would have generated a proposed penalty assessment. So it's important to understand that if that information is being sent to the IRS, then that penalty assessment would have been based on that information. So there's a big chance that if that information is corrected, that the penalty assessment will be reduced to zero or reduced substantially. As long as the IRS or the employer is in discussion with the IRS, the employer has that opportunity to make those corrections to the information and submit it back to the IRS. So it's always very, very important that the employer respond to the IRS in a timely manner. So gathering the data needed itself presents challenges to the employer. The IRS reporting is a very data-intensive process, as many of you may know. And again, bad data going into a software system or technology solution used to create the IRS forms will result in bad coding on the IRS forms themselves, and this can result in the assessed penalty letter. Employers may also face challenges with locating the necessary data within multiple separate systems. This may include hours that may only be captured in a payroll system, offer information in a benefits administration system, paper file, or elsewhere, and then enrollment data that may only be available from the carrier. Another source of difficulty is keeping track of all the different time frames used for different purposes under the ACA. This includes the different measurement periods or for look back to determine the full-time eligibility of the employees, offer and coverage information for the tax year, and then non-calendar plan years that may have multiple measurement periods, and then offer and coverage information for multiple medical plan years. In addition, new hires, terminations, position changes, and dropping or picking up new coverage will impact the coding on the Form 1095C. So if it's not captured accurately, this can really create some issues for the employer. Another thing that can cause some mistakes is keeping up with the unique employee population that may not be your typical full-time employee or your variable hour employee. So you want to make sure that if you have any of these unique populations that you make sure that you're keeping track of the hours. And I think I skipped over a slide. So another issue is the breaks in service. Breaks in service can be a particular challenge, especially if we're looking at the rehire breaks in service. The employer needs to remember how the rules work if the employee is rehired within the 13 weeks or after the 13 weeks period, and how that employee is treated from now on from an ACA perspective. So now let's take a look at some areas that the employer will want to review that is included in the ESRP letter. The first thing that we talked about earlier was the summary table itself, and how it included some information that would indicate how the IRS came up with the penalty assessment. So the summary table contains very important information. In the sample that's on the screen right now, we're looking at the first column that has all the different months that I mentioned before, and then it has the column A. Column A on the summary table reflects if the employer met the minimum offer requirement. So if the employer offered to 95% of their full-time employees for 2016 and after, or to 70% for 2015, they're going to note that in this column by saying yes. When the IRS sees a month that reflects no, that's basically the employer saying that they did not meet that offer standard. And so this can trigger a penalty from the IRS if an employee goes to the exchange and gets a premium tax credit for that particular month. The next column on the employer summary table is column B, and it is a calculation or a total of all the full-time employees for that employer. And this is important because this number is used to calculate the penalty, the Part A penalty for that employer. So obviously, if that number is too high, if you've got people included in that number that aren't actually full-time employees, then the penalty assessment itself will be higher than it should be. So the employer will want to make sure that that number is accurate. The next column is the transition relief column. In 2015, there were various forms of transition relief that were available based on the size of the organization and the medical plan year. So if your organization qualified, the transition relief must have been claimed on the Form 1095-C and or the Form 1094-C as applicable. You should be sure to verify that the correct number of employees are being reduced from your overall full-time employee count. So remember that for 2015, you could reduce your employee count by 80 employees, and then for 2016 and after, it was 30 employees. So you want to make sure that you're looking at the right tax year, that the reduction of employees is the correct number. And then if any of the information on the summary table is incorrect, the employer would simply make a copy of that particular page and then make any corrections to the data that's on it just by hand using an ink pen. There's nothing fancy that the employer needs to do to make those corrections. Just do it by hand with an ink pen and submit it back to the IRS. As you're reviewing this information on the summary table, you may want to ask yourselves a few questions. First of all, did you send a 1095-C to employees who were not full-time employees? Only employees with full-time status for at least 1 month in the year should have been sent the 1095-C. There is a narrow exception that applies to the self-insured employers who issue a Form 1095-C with special coding to all employees enrolled in the self-insured coverage, or employers who are eligible to use the 98% offer method. If you provided a form to employees other than the full-time employees, this is considered over-reporting. And there are some potential issues with over-reporting for the employer. This can include, obviously, the wrong employees would be receiving a 1095-C. The full-time employee count, particularly on the summary table, would be incorrect, which could affect the penalty assessment. And then, of course, the IRS reports would be incorrect as well. A frequently asked question that we get is, if the employee listed on the Form 14765, that's that premium tax credit listing, was not a full-time employee and should have never received a form, what do we do to correct that? And we found that some employers may have had some difficulty applying the look-back measurement period rules to determine full-time status, or may have faced data limitations or technology changes that resulted in the forms being issued to part-time or non-benefit eligible employees. And there's really no place on the form 147765 to let the IRS know that a particular employee should not have received that form. So if a penalty is proposed for an employee who is not full-time, the employer should check the box indicating additional information attached on that 14765 table and include a separate statement explaining that the form was issued in error. That's just about the only way that you can explain what had happened to that particular employee. And of course, you'll want to include all of this information in your cover letter. You'll want to make sure that you are referencing that you have attached all this additional information in your cover letter to the IRS. Another question that you will want to ask yourself is, did you remember to enter the applicable safe harbor on line 16 of the employee's 1095-C? In some cases, there was no offer to a full-time employee, or if there was an offer, the coverage may not have been affordable. If there is a safe harbor or other relief that applies, the employer may be protected from getting an ESRP assessment. Leaving off the applicable safe harbor code could result in a penalty assessment. So if a safe harbor code applies, you will absolutely want to be sure to include it on the form. And then the last thing that you'll want to ask yourself is, did you enter the correct code on line 14 of the 1095-C? You want to verify this information very carefully, because if you use the wrong offer code, it could be an automatic trigger for a penalty if there's an employee that receives a premium tax credit. Some examples are if you use code 1H, which is basically saying no offer was made. If you use codes 1B, 1D, or 1J, this is saying that you did not include dependent children in your offer. Or if you use code 1F, which says that an offer was made but it didn't meet the minimum value adequacy standards. On the screen are some commonly used line 16 safe harbor codes. For more information about these codes, you'll want to go to the IRS instructions for Form 1094-C and 1095-C. I'm not going to go into a lot of detail on these, but you can find the instructions on the IRS website, and the link is actually located at the bottom of this screen. So what should you do if you receive one of these employer shared responsibility payment letters? First of all, don't panic. It can be kind of scary when you open the letter up and you see that huge penalty staring you in the face, but just remember that you do have the opportunity to go back and work with the IRS to see if there was some misinformation that could have caused this penalty to be generated, or at least if there was some corrections to be made, that penalty may be reduced. You'll, of course, want to engage with tax or legal counsel immediately so that they can assist you in getting this response drafted. And if you utilized any third-party vendor to help with your 1094 or your 1095 creation, or if they are tracking any kind of data for you, you'll want to get them involved as well. Again, look at that first page of the letter and see when your response date is, and if necessary, go ahead and request an extension. We found that many employers that get these letters, the letter isn't delivered to the person that should have gotten it immediately. Sometimes it goes to another person, they don't know what to do with it, so they let it sit on their desk for a while, or it kind of travels around the office a little bit before it actually gets to the person that should be responding to it. So once you open it up, if you've got just a few days to respond, go ahead and pick up the phone and ask for that extension. And again, the IRS has been very willing to provide those extensions so far. And of course, as I mentioned before, respond timely to all correspondence. If you get a response back from the IRS asking for additional information, be sure that you respond back as quickly as you can to them. Okay, Now let's look at some employer responsibilities concerning the reporting requirements themselves. So what happens if you forgot to file for a particular tax year? The IRS, along with sending out the employer shared responsibility payment letters, has also started to send out another letter. This is letter 5699. This is being sent to employers inquiring about possible missing filings for a specified tax year. The letter will verify with the employer why no forms were filed for the tax year, and then the employer will have 30 days to respond to the letter. Of course, failure to respond timely could generate a penalty assessment itself, so you'll want to respond back as quickly as possible. There are 5 possible responses that the employer can make to the letter 5699. First of all, the employer can respond back and say that it was an ALE, an applicable large employer for the tax year in question, but filed its forms 1095-C under a different entity. The employer can respond and say that they were an ALE for the tax year in question and is including the 1094-C and 1095-Cs with this response. But just be aware that the employer can only mail those forms to the IRS if they have fewer than 250 forms. If they have 250 forms or more, they have to transmit those to the IRS electronically. The employer can respond that they were an ALE for the tax year in question and will be filing the forms 1094-C and 1095-C with the IRS by a specified date. And it can't be any more than 90 days from the date of the letter. The employer can respond and say that they were not an ALE for that particular tax year in question. Or finally, they can say that there was another reason that they didn't file, and then they could include a statement explaining why that the employer did not file the 1094-C or 1095-Cs, and can give the IRS an explanation of the actions that they'll take to remedy the situation. Okay, so next steps. Before the employer sends the response to the letter 5699, they want to consider some steps and tips. First of all, they want to determine whether or not they were actually an applicable large employer for the tax year. Sometimes the employer may assume that they were not an ALE, when in actuality they were. They should keep in mind that the controlled group rules apply whenever they're calculating their ALE status. So that would be if they're part of an aggregate ALE. If they are, even though they're a small group, they would still have that reporting requirement. They would need to review the rules for calculating their ALE status. So that would include making sure that they're including their full-time equivalent employees and determining whether or not they are an applicable large employer. And then they'll want to review any IRS transition relief for the employer in determining the ALE status for the tax year 2015. They will also want to determine whether the forms 1095-C were filed with a different ALE member in a controlled group, if they were part of one. And then, of course, they'll want to consult with legal counsel for assistance. So what does the IRS do to an employer that reported late or reported incorrectly? Along with the notifications for non-filing, the IRS is also sending out notifications to the employers who filed late. And employers that filed late just need to be aware that they may be subject to penalties. And these penalties can be up to $270 per return, and that means per 1095-C, for every one that was not filed with the IRS. That's one penalty. They can also be assessed for up to $270 per return, again, that's 1095-C, for not timely furnishing the form to the employee themselves. So that would be a total of $540 per return. For the 2015 through 2018 tax years, the government has elected not to impose any penalties for incorrect or incomplete information on employees for employers that can demonstrate that they made a good faith effort to comply with the reporting requirements. So if the information on the form may have not been complete, or if it was a little incorrect, the IRS is saying that the employer made a good faith effort and they're not going to impose any kind of penalty on them. Just be aware that the good faith effort does not extend to employers who fail to file their returns or who fail to meet the deadlines for furnishing a Form 1095-C to their employees. So the good faith effort does not cover the employer if the employer failed to file entirely. And it is important to note that the good faith standard may not be extended in future years. So we know that it applies from 2015 to 2018, but it's not guaranteed that it'll apply anytime after that. So how to proactively prevent problems? There are some things that employers should be sure that they're doing that will prevent problems that can result in the ESRP letters. First of all, they need to make sure that they are providing the notice of coverage options to their employees. And the notice of coverage option is a requirement under the Affordable Care Act, and it states that all employers are required to provide their employees with a notice of coverage options. This informs employees about the health insurance marketplace, that depending on their income and what coverage may be offered by the employer, they may be able to get lower cost private insurance in the marketplace, and that if they buy insurance through the marketplace, they may lose their employer contribution, if any applies, to their health benefits. Employers should be sure to fill out the form completely, including Part B, and provide it to all new hires at the time of hire. This will provide some necessary information to employees when they are making their benefit decisions. And so here is an example of one of those notices. Of course, the Department of Labor has two model notices to help employers comply with this requirement. There's one model notice for employers who do not offer a health plan, and then another model for employers who offer a health plan to some or all employees, and that's the one that's pictured on the screen right now. The next thing that the employer should be paying special attention to are any marketplace notices that they may be receiving. The marketplace notice is one of the first indicators that an employee has gone to the marketplace for coverage and that the employee has received a premium tax credit. Keep in mind that an employee is not eligible for a premium tax credit if the employer has offered adequate and affordable coverage to the employee. So this is the first sign that there may be something that's gone awry with the employer's plan. So when the employer receives this notice, you should be investigating the situation. We've had a lot of employers say that they get these notices, they don't know what they're for, they don't know what they're supposed to do with them, so they either throw them away or they just kind of let them pile up on their desk. But this is a first indicator that there may be an issue and a possibility of getting one of those ESRP letters. An employer can appeal a marketplace notice on just one ground, that the coverage was offered, that it met ACA standards, and that it was affordable under the ACA rules. Another thing that the employer can do to help prevent problems is for the employer to focus on employee education about their benefit plans. Better educated employees are less likely to give incorrect information to the marketplace and will be better consumers of health care. And of course, we've discovered that if you're a collectively bargained group, better educated employees also make better bargaining decisions. Another thing that the employer can do is to make sure that they're paying particular attention to new hires. They should apply what we call the reasonable expectations at the time of hire to help determine how the employer would treat an employee for ACA purposes. An employer should look at all the facts and circumstances of the position the employee is being hired into. If the employee is reasonably expected to work on average 30 or more hours per week or 130 hours per month, the employer should treat the employee as a full-time employee, meaning they should offer them benefits and all of that. If the employee's hours are unpredictable, seasonal, or known to be less than 30 or more hours per week or 130 hours per month, the employer should treat that employee as part-time, seasonal, or variable hour. If using the look-back measurement method, the ACA rules require that part-time, seasonal and or variable hour employees be tested over an 11 to 12 month measurement period following the date of hire in order to identify the status for ACA purposes. This initial measurement period can start on the first day of the month following the date of hire, or on the date of hire if the start date is the first day of the month. And that allows you to group the employees by month. Then you would track the total hours over the 11 or 12 month initial measurement period to determine each employee's average. Once that's done, the employer can utilize a 1 to 2 month administrative period to identify who those employees are, the ones that are full-time, and they will be the ones that are eligible for coverage for the next 12-month stability period. Many employers have mastered the ongoing standard measurement period applicable to all employees, but sometimes they forget about the part-time, seasonal, and variable hour employees. Here's a tip: just make sure that you've developed a process to remind your team to review the closing of the initial measurement periods at the same time each month. And this way you will know who those employees are at the end of the month that are eligible to be offered benefits for the next reporting period, for the next stability period. Okay, and finally, another thing that the employer can do to help prepare or help prevent the possibility of an assessment letter is preparing for the possibility of turnover, especially in the position that handles all of this ACA reporting for the employer. And we all know that turnover happens, and so it's just really important that if somebody that's in charge of doing this process for the employer should leave, that there is documentation or training available for somebody else that's stepping into that position. So the employer should plan for any successor to take over that role should there be turnover in that position. And there should be documentation that lets everyone know what method the employer uses to identify full-time employees, when the coverage is to be offered, and then how much the employees will be required to pay. It should also include how the offers will be communicated to the employee and how those will be recorded. And that is the end of my prepared comments. I'll turn it back over to Melissa to see if there are any questions.
Wonderful. Thank you so much. One of the best things about helping host webinars is how much I learn about topics that I had never really considered before. So thank you so much, Mary, for sharing all of that information. So while I give everyone an opportunity to type in any questions that you might have, I do want to remind everyone that both the PowerPoint slides, a PDF of the slides, as well as a recording itself will be available. The slides will be available immediately, and then the recording will be up before the end of this week. So again, you'll be able to share the link or the information if there's someone else in your organization that could also benefit from today's presentation. So let's see. Let me take a second to read this question. All right, Mary. If we offer coverage to an employee and they refuse to complete the online waiver, can we choose to not give them coverage, or are we required to automatically enroll them?
Okay, so if they refuse to fill out the online waiver, I think it's just a matter of documenting what all has happened. The employer has made the offer, obviously, and then if the employee chooses not to accept that offer, the employer just needs to make sure that they're using their correct safe harbor if one applies. So I would just document that the employee chose not to fill out the online waiver, but that the offer of coverage was made to that employee.
Okay, so document, document, document.
Absolutely.
Okay. So what should I do if I don't hear from the IRS after I send my response?
If you have replied back to an appeals letter, or excuse me, if you are appealing a assessment letter and you have not heard back from the IRS, there's really nothing that states how long the IRS has to respond back to you. But I kind of use 30 days as a rule of thumb. We have learned that with the government shutdown that has kind of delayed, it's still delayed some of the things that are happening with these ESRP letters. So it's highly likely that it's going to take a little time for the IRS to respond back to the employer. So I would say if you haven't heard anything within about 30 days, you can contact the IRS and just ask them for a status update on your particular situation.
Okay, so if we're going with a rule of thumb for 30 days for a response to our response, what is your estimate for the window of getting that initial letter to begin with? What's the window for receiving a letter for a certain tax year?
There really isn't anything. What we have found is that starting around the fall of each year, the IRS starts sending out the new letters for the next tax year. So, for example, probably around September of this year, they'll start sending out any penalty assessment letters for the 2017 tax year. But that doesn't mean that they can't still send out penalty assessments for the 2015 and the 2016 tax years as well. To my knowledge, there's nothing that really ends the point in time when they can stop sending out those penalty assessments, but they do try to move on to the new tax year with some degree of efficiency. So there would probably be some extenuating circumstances if they're still getting 2015 and 2016 tax assessments in 2018 or 2019.
Okay. I guess that kind of makes sense. There never seems to be a statute of limitations for the IRS, right? They can.
Right. Absolutely.
So then if I got a letter for 2015, is it possible or likely that I'd get one in 2016 or 2017?
Yeah, I mean, there are situations where it could be highly likely that you're going to get one for the next tax year, especially if there was an issue with your system or process that caused some bad information to be reported to the IRS. If you haven't resolved whatever that issue was by the time you did your reporting for the next tax year, it could result in you getting a penalty assessment for that particular year. But keep in mind that the thing that drives these penalty assessments is if somebody went to the exchange and claimed that premium tax credit. So you may still have an issue with your data or a system challenge that may be reporting bad data to the IRS, but unless that person or a person goes to the marketplace and gets a premium tax credit, I'm getting tongue-tied, that penalty assessment letter will not be generated.
Okay. Okay. So at least if you get a letter, it should direct you in a way to maybe help minimize any chances or minimize the chances of it in the future, right?
Right, absolutely. If you get a letter for 1 year and you discover some type of issue with a system or a process that needs to be corrected, obviously you're going to want to do that right away so that it doesn't affect future reporting years. But unless you've been able to correct it prior to that particular reporting year, there's a possibility that you can still get those penalty letters for prior years.
Okay. Okay. Well, at least when it comes to Q&A, I think we've managed to cover everything. So, Mary or Gabor, do you have any closing thoughts for us today?
I don't have anything. Obviously, if anybody out there has gotten one of these letters and they need assistance, I'm more than happy to offer whatever guidance we can offer to help them resolve it. They can contact me at the email address that's on the last slide here. Turn it over so you can see it, possibly. Anyway, there we go. So if you want to send any kind of questions or anything to that email address, we'll be happy to help you out.
All right. Well, wonderful.
And I would,
go ahead, Gabor.
Melissa, I would just, that's fine. Sorry, I apologize. I would just say in closing too, the same thing for, just like Mary said, I am local in the state. So if you do get something that throws you off or anything and you need someone to take a look at it or whatever, I am close by. My email address is my first name .ciclosi@americanfidelity.com. So and Melissa would have that as well. So we're just here to help, and if there's some way that we can make your life easier, we're glad to talk to you about it. So thank you very much, Melissa. We appreciate you and CML and those folks that are on this webinar. We appreciate your service to your communities, and glad to help you guys out however we can.
Well, awesome. I know CML appreciates the relationship that we've had with American Fidelity over the years. So I'd like to thank you, Mary, and you, Gabor, for coming today, for sharing your knowledge with all of our attendees. And of course, I would like to thank our attendees as well for joining us today. So one last reminder, you will have access to a PDF of the slides and to a recording of today's webinar posted on our website by the end of this week. If you head to cml.org under training materials, you'll be able to access slides and webinar recordings. So I'd like to thank all of you for joining us today. This does conclude the webinar, and have a nice afternoon.